Up, everybody on LinkedIn? I'm Mark Updegraff. I'm here with my co-host Matt Drouin. We are waiting for Yonah to get into the room, but I'll read his bio while we're waiting. And if he doesn't get here yet, then we'll just start rapping. So, Yonah Weiss is the business director for Madison Specs, providing expert engineering-based cost segregation studies. Cost segregation is an IRS approved process that reclassifies real estate components and improvements to accelerate depreciation deductions, defer taxes, and improve your cash flow. Yonah's team of engineers and accountants analyze construction contracts and building plans to identify assets that qualify for accelerated depreciation for tax purposes. They always perform a no-cost feasibility analysis on your property to demonstrate the financial benefit of having such a study performed. Yonah has been featured on over 400 podcasts, and he is an excellent teacher, mentor, and go-giver, helping countless people in the CRE space. His company works in all 50 states, and all types of properties can benefit from the significant tax deductions of cost segregation, including multifamily, office, retail, mixed use, hotels, golf courses, mobile home parks, shopping centers, restaurants, skilled nursing facilities, industrial, flex, banks, and self-storage. If you own property worth over $500,000, excluding personal residence, that was purchased, developed, or renovated within the last 5 years, and you want major income tax savings, Yonah and his team can help with a free cost segregation feasibility analysis. And here he is. So I am going to bring him right on.
Hey, what's going on,
Yonah, how are
guys?
you?
Doing well. How are you guys doing?
Doing excellent. Thank you so much for coming on.
Happy to be here. I was actually having some technical difficulties in my office, so I had to run home and doing this from my laptop at home.
Oh,
But
cool.
it's great. So I don't have my usual studio setup and high-powered microphone. But are you hearing me all right?
Yeah, you sound great.
All right.
Absolutely.
Well, great to be here.
Yeah. So I listened to your Millennial Investing podcast that came out about a month ago. So I got a lot of good background, which was nice. They did a really good job. Robert did a really good job interviewing you. So that was really cool. I figured we would focus more on kind of like what's happening now and what you specialize in. And then I'm particularly interested in like how you built your real estate side and what that looks like in comparison to like your business side of what you do.
Absolutely. Sure. Yeah. I'm open book. So happy to share.
Cool. Well, do you want to start by just giving the audience a little bit of background? I'll tell them that they should definitely go and listen to that other podcast because that was really sweet and in depth. But
Absolutely. And as you mentioned in the introduction, I have been a guest on over 400 podcasts. So there's pretty much, not a topic besides cost segregation that we haven't covered. So, but things change, and I'm happy to kind of share. My background is I was a teacher for about 15 years before I got into real estate, which is going back about 7, 8 years ago at this point. Started out really knowing absolutely nothing about real estate and got my feet wet, really shadowing a good friend of mine, apprenticing, if you will, who was a commercial mortgage broker. And he had experience. He owned his own small multifamily properties and did his own, property management and everything. And I was just, fascinated by commercial real estate. And fast forward about a year or so, I ended up becoming a licensed broker as well, just trying to learn how to do residential brokerage, really for the investment side, to learn how to find properties and how to find maybe opportunities, development, and things like that. And did a couple fix and flips, was not really into it, didn't have a lot of fun doing that at all. It didn't really make much money. We did have some investors involved and didn't make really much money whatsoever, besides for returning the investors' capital. And then I started with this company, Madison Specs, Madison Commercial Real Estate, who is the largest national cost segregation company, really through an introduction. And this goes back to something I talk about a lot, which is just being open for opportunity. And when you're kind of that, abundance mindset and just out there kind of sharing and seeing, where relationships and where networking can lead you, you never know what is going to pop up. And so I was at that moment in time, I kind of put it out there to a few friends that I had been doing the brokerage, I had been doing the, the commercial mortgages, and it really wasn't that fulfilling. I loved the networking, I loved meeting people, I loved, kind of that aspect of it, but I didn't really like the underwriting side. I didn't really like the hustling of running from one house to the other and all that kind of stuff. And I just put it out there to a few friends saying, hey, any opportunities? And then I was introduced to this company, Madison, and learned very quickly about cost segregation and quickly became like the world expert on the subject. Really, because I think because of the teaching aspect and, a lot of divine providence, I would say, because it's unbelievable how quickly a network can grow by using social media. And that's what I did. And through that, and I would just be totally, transparent here. Through that, I was, meeting tons of clients, having relationships with through the cost segregation in from the business development, from the sales side of the business, not actually doing the engineering or the accounting work, just through the social media, through podcasting and doing webinars and educating people on this subject. I ended up meeting the most amazing people, syndicators and real estate owners all over the country in every asset class, and people talking about financial independence and investing and getting passive income and all that kind of stuff, which I never really knew before. And so it's going back, 5 years or so. And through that opened up to me opportunities to invest as a limited partner in many syndications. So to date, I've invested in about 8 different multifamily, self-storage, mobile home park, and RV park syndications.
That's awesome. Do you have any advice for vetting an operator? How did you go about that? Because I'm sure you had a lot of people, like you said, as you were growing your network online. I'm sure all kinds of people would have loved to have you invest with them. How did you pick who you wanted to place your money with?
Absolutely. That's the hardest part. That really is. And it's not something that comes quickly. It's very difficult. Even if someone has a great track record, you have to believe in them and you have to develop that trust. I mean, are you going to be wiring, $50, $100, $200,000 to someone that you just met or have known for a few months? I would not recommend that. I'm sure there are plenty of people that do that, but I would not recommend it. So there is a lot of levels there. You asked about, how to vet the sponsor. There's a lot that goes into even the deal itself, but the sponsors, it took me years of just getting to know people and spend in person, going to events and speaking with people, meeting people in person, not necessarily with the intent, at least they didn't necessarily know that was the intent that I was going to invest with them, but just getting to know people, you can tell pretty quickly, who you'd like to invest with and who you'd like to stay very far away from. So to date, I'll just give a quick example without naming any names. There is, someone out there who is a big social media presence. I'm not talking about Grant Cardone, not that big, but on the same kind of vibe where it's just like putting out content, talking about how we're making money and all this stuff and how many units we have and all this kind of stuff, and been guests on all kinds of podcasts. And I always personally felt very uncomfortable around this person. It was just like a vibe that I didn't connect with. Now, I'm not a really materialistic person whatsoever. So, when people are like flashy about cars, and that's fine if you like that, it's just not my style. Like if you're flashy about the new watch and the new cars and showing off, I'm much more connected with people who are about giving back and people who are about education and people who are about how can make an impact in the communities and how I can make an impact in my investors' lives, as opposed to showing off how much money we're making and how much money we're making our investors. And when it's all about the money and you're missing what's really behind that. So this person, again, not naming names, it was like that gut feeling. And then I had someone who I very much trust, a client of mine, who had told me in confidence that they had invested. They're a big GP, own, a few dozen properties and, really, really good, high quality. And they also invest a lot of limited partner before they got started, and also continuously invested as a limited partner in many other people's deals. Because when you have a lot of money, you want to diversify if you can. And so you put into other people's deals as well. and she had told me that she lost money in this person's deal, and there was some real conflict of interest stuff going on with that GP, with that person. And so it just made me feel validated in my gut feeling. But again, that takes time to really develop who you are going to connect with.
Wow. Now I'm going to be scratching my head trying to figure out who that is.
No, don't try.
I'm just joking. I'm just joking.
I may have made up the whole thing anyways.
Yeah, I was just kidding.
I have a question on that. Actually, kind of a statement. One of the best words of advice one of my investment partners ever gave me was, I only do business with people I feel good doing business with. And it was so simple and so beautiful, because I've done business with people in the past that I just had like gotten a gross feeling around, or I just didn't have that sort of like alignment where I felt like I couldn't really like communicate with them. And and I'd done business with with those types that just weren't kind of like vibrating on my frequency, so to speak, and it was always a disaster.
Yep.
Did you have any like inklings when you met the person for the first time that it was somebody you resonated with, and then that ended up being truly the person that you placed your money with, or is it more you need the time to really make that decision?
No, there's usually an immediate. I'm a pretty good judge of character, and so there are really dozens or scores of people that I know that I would invest with at this point. And then it really comes down to, okay, well, I only have a finite amount of money that I can put in. So again, going back to the position that I'm in, I'm also on hundreds of email lists, which I've unsubscribed to most of them at this point. But that means you get the deals that are coming in, especially over the past few years. It was just like nonstop, like deals coming in. And so you can see, I'm also, as you, Mark, part of the Raise Masters and, Mastermind, and you see people who are doing deals and you get to know people through that. But I think immediately you can pretty much judge the character of people to a certain extent. But again, it will take time to get to know them through, whether it's through Zoom calls or whether it's obviously meeting in person is the best.
Yeah.
Mark, can we back up a little bit?
Yeah.
So, my wife is an educator. I'm curious to what was like the seminal moment or moments that like real estate.
So it's funny because I never was into business or was never into finance and knew very little about real estate growing up. And even as an educator, there was a certain moment in my life where I had a little bit of a family crisis, and I knew I needed to make a change or make some sort of transitions and find some other means of income. And I was open to opportunities at that point. And I put out feelers to, a few friends of mine, like, hey, any ideas? Like, should I do this? Should I do X, Y, Z? And I actually tried out a few different things that I thought I would be passionate about or be interested in. Was not. And I was okay being open to just, not feeling like I needed to commit to something immediately. But real estate kept coming up among, friends, conversations, and people that I knew, acquaintances and things. And I thought of it like the moment I knew was like I made a decision. I'm looking for something that I don't really want to do any more formal education. I had spent many years, I had undergraduate, but also postgraduate and a lot of stuff. And, I didn't enjoy the classroom as a student so much, but I love, this being a student experientially, and I love being a teacher. That being said, I was like, okay, what profession can I go into that I don't need any necessarily formal education? And so real estate seemed like something you could do. And there's so many different things in real estate, and sales also something that you could, pretty much get into in any regard. And really anything you do is combined with sales in some way or another. Yeah. And then the other aspect was, well, what kind of profession or what kind of industry out there kind of has no limits, no ceiling in terms of the potential that that you could make in terms of earnings, but also the impact that you could have. Because again, when I talk about like making money, I've invested quite a bit, but I've also given away, and giving to charity, probably at least the amount that I've invested. And so it's like I always try to balance, how can I give back? How can I find people who are in a situation where I was in? I've been in a place where I was teaching and had a lot of debt and was really struggling. And my wife wasn't working and we had a bunch of kids. It was like, not just paycheck to paycheck. It was like, debt totally maxed out, not having money in the bank account, and not knowing where you could literally, pay rent next month or, pay the grocery bill. And so I've been there, and I know that people have been in that situation or are in that situation. So I'm always looking to find people in my community and find people around me that are in that similar situation and just kind of lend a helping hand when I can.
That is so cool. Have you started any nonprofits?
I did many years ago. This going back probably about 10, 12 years ago, I did start a nonprofit. And we had spent a lot of, money fundraising. And so I actually spent a couple of years while I was teaching, like during breaks and things like that, just literally fundraising. Like I would travel around the world, literally. I've been to like 6 or 7 different countries, collecting money from different communities. And I really did not enjoy that very much. So I got some phone ringing over here. I don't know what's going on with that. I don't know if you hear that.
It's no problem. And what was what were you fundraising for?
So this organization was, I could probably find that phone and try to stop it. Someone's cell phone's in here. It's what happens when you work from home. You lock yourself in a room and then you're stuck with a phone in there.
It's the entertainer, right?
It is. That is a great ring. Yeah. So the organization was basically trying to help people who had illness in the family or immediate family, had medical bills that were beyond them, or had a death in the family, and something extraordinary circumstance that put them either out of work or out of a spouse out of work, or losing a spouse or something like that, and trying to help people who are in those like extraordinary situations with just basic needs, literally. Food vouchers and coupons and clothing stores and things like that. And around the times of the holidays, we have Jewish holidays by in our communities can be somewhat expensive, and tuition can be expensive. And so just trying to help people keep up to their not go deeper into the hole.
Yeah. So are you just investing in the US, or are you investing outside of the US as well?
Just in the US. Yeah, solely in the US.
Do you think you'll change that ever, or are you going to stick with US?
I know the US, I know the markets, and I'm very, very deeply involved in it. So it would take having to travel to or spend time in another country to really get to know it. I would never say no. Like I would never invest outside of the US, but an opportunity might have to present itself before looking into it.
Do you stick with like the markets that you know very well, or do you explore new markets within the US, as things change and demographics shift and stuff like that?
Always exploring new things. And the amazing thing is there's always shifts, always going on. The one thing that I'm very grateful for, one thing that I'm very grateful for in the position that I'm in, is that I literally have like a bird's eye view of all of the markets and every asset class that's out there. So because like I said, like thousands of clients that we work with around the country that are closing deals and buying real estate and, self-storage and multifamily and, office, industrial, you name it. And so you really get to know if you pay attention, you get to know just from that. Obviously it's not like, macro trends, but you get to know a lot. And so I've learned about tons of new markets. And one thing that I have learned is that it really matters more than anything who is your boots on the ground. Like if someone is investing in a place that's like, I'd never invest in a place like that. But if you have someone who's local to that market and is extremely well, I'll give an example. This guy we had on our podcast a couple months ago, Gabriel Hamill, he lives in Eugene, Oregon. I'm like, why would I ever invest in Eugene, Oregon? But this guy, he's been doing it for 20 years and he's bought, a couple hundred properties, transacted on, and he's just very successful because he knows his local market and he knows who's there. Are there a lot of out-of-state people coming in investing there? No. So you have the advantage of a total tertiary market, but real estate is real estate. And so if you're a local expert, you can do very well. And I'm sure you see the same, in Rochester. It's like people from out of state. I mean, there's the single family people buying single families, and that's kind of a scam in Rochester. I don't know if you've heard about that, but if you're local in a very tertiary market, you can be very successful.
Yeah. I'd like to hear what the word about the scam is. I mean, we know there's scams up here all the time, but I'm just curious as to what scam you're referring to.
I came across many years ago someone trying to, people, you can buy properties and single families, invest with us and buy a property for, $30,000, a single family house or something like that. Right. Mm-hmm. And, they don't tell you that it's like Section 8 or that it's very kind of bad neighborhoods and the tenants are going to end up not paying rent and end up stealing like the copper from the pipes, things like this. And you're left with, you put $30,000, you can't do anything. And essentially the person who was doing, I saw this many years ago, they ended up getting busted. But what happened was they were charging, like a fee, and they were basically like getting people to buy these houses, saying that there was property management, saying that there was all this stuff going on, and and taking a big $5,000-$10,000 per transaction, and selling hundreds of these houses, and it just ended up being a big scam. A lot of people lost money.
I know who you're talking about. Yeah,
American Real Estate. That was the name of this. That was the name of one of them.
There's I'm sure there's been more.
Yeah.
But again, you go to any inner city, and you can have something like that happen.
Yeah, the $30,000 houses are very difficult to deal with. If you're not from Rochester, don't buy one. Definitely don't buy one.
Whenever somebody sends me one of those, and my out-of-state friends, that sort of thing, I always text them back the Admiral Akbar, it's a trap, jiffy, because it is, and cash flow. I mean, it when you underwrite those properties, it's like the numbers are screaming at you off the spreadsheet, but the thing is that the cash flow is a myth, and it's unfortunate because we have we struggle with lack of affordable housing in our community. So there's people that go into this space thinking that they're going to do, hey, I'm going to be responsible, I'm going to take care of my tenants, I'm going to take care of the property, and it ends up being kind of a raw deal, for them.
Mm-hmm.
So do you maintain your broker's license, or did you let that lapse?
No, I let that lapse.
Yeah.
It was it's not just something I wasn't really interested in for very long, and kind of found my calling in what I do now. And I just kind of have a great thing going for me in that I basically could set my schedule. I love doing podcasts basically every day, on a different podcast. And it's great, having fun, educating people, and being able to spend time with my family also is really important to me.
Yeah. How do you decide what percentage of your time that you're going to spend on, the LP side or the investing side versus how much time you need to spend on your cost segregation business? How do you make that determination? Do you fluctuate it? And talk a little bit about that.
I've spent many years, 5 years, 6 years or so, just plugging away nonstop with the cost seg and just pushing forward and building a huge audience and a huge client base. And, we've grown to, like I said, being the biggest cost segregation company. We did last year in 2022, over 7,000 cost segregation studies across the country. So, it's really, I'm very grateful that, we're able to do that. And so being able, I continue to put, everyday efforts into, and we've built a team. And so I'm not really needed so much more in doing that. So I focus a lot more on just creating content, putting stuff out there. Obviously I have client calls every day and things like that, but I focus a little time, and then essentially the LP investments is whenever I have a little money, just put it in a deal. And there's really thank God, because of the vast network, I really have no shortage of deal flow from trusted people. Like I said, there's really a lot of people that I would and have put money with, and so I'm very grateful for that. So there's really no shortage of that, and hopefully that will continue to be the case. I don't know that it always will, but so far it's been that way.
Do you think you would launch any other ventures in addition to the cost seg, or just kind of stick with what you know and continue to operate the way you are?
I'm always open to opportunities, to be honest. So if something really good comes my way and seems like a great thing, I've been very actively studying the short-term rental market, trying to buy a short-term rental. And really, my plan, I don't like hospitality so much from in doing it. Like I don't think I would be very good at running an Airbnb per se. I like the business model. I like that, and I've spoken to hundreds of people who've been successful in running their own, self-managing their Airbnb. So that's one thing I'm really interested in. I've been looking at it for probably like a year and a half. And so I haven't pulled the trigger on actually buying a property, but my plan right now, and I've mentioned this a couple times, is I have a daughter who's 18 now, and she's she's thinking about what she wants to do with her life, and whether to go continue school or whatnot, get a job, whatever. And I ran the idea by her, and she's really into it, like learning about Airbnbs and maybe buying something together with her and having her run it and see if that works. I don't know if it will, but I'm willing to take the risk and see if it goes well, because if it does, that'd be awesome. And help her out and start early on. And so that's one thing I'm interested in. I've been involved. I've done the GP side of a deal in terms of a general partnership, raising capital, and that's why I joined Raise Masters. So I've done that a little bit. It takes up too much time if I'm doing the Cossack thing from right now, so I haven't really run with that, but I've been offered an opportunity to join a very successful company as a co-GP on a fund that they're starting soon. So if that plays out, there you go. There's another venture, I'll obviously put a lot more time into. And again, I really love the real estate community that, and the community that we've built over the years. I don't see myself like just turning away from that and doing something totally different. Like if there's something that I can continue to do within that beyond my capacity in the Cossack business, I think I would.
Yeah. That's so cool. Do you have any tips for people that are just getting started on LinkedIn? I have only been active on it for a few months, and every time I look at what you're doing, you like just blow my mind. I'm like, it seems simple, but it's so genius,
Yeah. I think, as Mark, right? We've talked about this a little bit, and you've obviously messaged, and you've started out doing pretty well. I'd say for someone who's just been doing it for a few months, really doing well at it. And what I mean by that is probably the most important thing is consistency. If you can just commit, and this is why we do this, 10-day challenge that we do every few times a year. If you can just commit to posting original content, for every single day for a short period of time, you'll get used to it and you'll just get better at it over and over again. If your focus is trying to add value, you'll end up doing well. And more importantly, I think, than posting on LinkedIn is just learning basic etiquette of how to use any specific platform. Every platform, every social media platform is different. LinkedIn really rewards engagement and rewards comments specifically. And so, more than shares. Like I know, like Twitter, if you retweet something, like that's great, like that's huge if you retweet. But on LinkedIn, it doesn't work. Like if you share a post, it will get almost like no reach whatsoever. However, if you comment on a post, that will end up, showing that to other people in your network, in your home feed. So spend more time commenting on other people's posts strategically. Find the right people that you want to connect with, and you want to have exposure to them and their audience, and spend time commenting on their posts more than you do actually on creating your own content. That's probably the best advice that I could give for someone starting out.
I have a follow-up on that too, because as we're learning in the mastermind, you want to niche yourself down and you want to know who you're talking to. But then when you're on LinkedIn, it's real easy to say, oh, I really like this stuff that these people are doing about social media or about ChatGPT or about talking in public or whatever. And they all have their own communities.
Mhm.
And, do you find like you can just go ahead and be active in all these various communities from like glass blowing to yoga to whatever? Or do you really have to focus on finding the right communities that are going to resonate with your target avatar?
It is really important to find the right communities. It's really important to find the right people that will end up seeing who you're, what you want to be showing. Right. The point of LinkedIn and social media, I think the most important point of it is two things. One is personal branding, so that when people see you and recognize you, they know who you are, what you do immediately, and how you can help them. And so you can't be too all over the place, because most people, some people, a small amount of people will get it and kind of get the whole you picture. Oh yeah, you like yoga and you like this and you like that and real estate and glass blowing, whatever things you said there, right? But they won't really get who you are, what you do, and how you can help them. And if you can hone down what that is and continues with that, the vast majority of people will know that and get that. So it's a skill of really honing down. It doesn't necessarily mean you have to always stay within that framework, but I would say 80-90% of the time you should.
Yeah.
Because again, any posts that you engage with, it's going to be showing up in your network's feed. Because if you go to your home feed on LinkedIn, you'll see, a post from someone you're connected with, but usually what you'll see is so-and-so commented on this post, so-and-so liked this post, and showing your connections, who you're connected with, your first connections, are engaging with other people's posts. So you're not necessarily seeing posts firsthand from people in your network. You're seeing things that other people in your network have engaged with. So too, what you engage with is showing up to other people. And so you want to make sure you're not turning off your network by engaging with stuff that you don't want. And I literally use the unfollow button every single day. If I go to my home feed and I see someone's like, posting about stuff that's political, or not posting, just engaging with stuff that's political, like I don't want to see that. So I just, click the three dots, unfollow. I'm still connected with that person. We can still, converse. We can still have DMs, etc. But I don't want to see stuff that they're engaging with in my feed. I want to curate that. So my experience on LinkedIn is going to be the positive experience that I'm looking for. I want to see, when I go to my home feed, I want to see those posts that are focused on real estate and things in that involvement. So that's the advantage of doing that. So many people, it's funny because I became very active on Twitter lately, a few months ago. And there's like a whole retweet, like real estate Twitter community out there. It's pretty cool. And it's fascinating to me that there's so many people on Twitter in the real estate world that complain about LinkedIn. It's like, it's hilarious. It literally, you see it all the time. It's like, oh, I can't stand LinkedIn. It's all about, patting people on the shoulder. It's all about self-promotion. It's all about this and that. And I'm occasionally, I'll chime in like, we're not seeing the same LinkedIn, right? Because you experience it basically what you, what you choose to focus on, that's what you're going to see. So too with Twitter. Like if I was just on Twitter and seeing everything, I hated Twitter for many, many years and would stay away from it because of the negativity, because of the politics, because of all that stuff. And then I found this retweet where you can compile or follow specific lists of people where all you're seeing in your feed, if you curate it this way, is people that are on this real estate list who are very specific. So I don't see anything outside of real estate on Twitter whatsoever. And so it's amazing. And so the same thing can be done on LinkedIn. It's a little bit harder, but it can be done.
So I'd like your opinion on something, LinkedIn wise. I've been very active over the past like 5 or 6 years on Facebook. I have a medium-sized audience and Instagram. And so I do a lot of video, just because, and it's always value derived. Want to put like, something that's going to be a value out there, whether it's insightful or motivating and that sort of thing. And so I've always been wondering about, do I just not do the video when I'm doing the content on LinkedIn and just do like the copy that I would normally post with the video? I've just been curious about people's take on that.
You always have to try out different things. So there's no right or wrong answer to that. You can try out things. And in fact, for over the years, I've seen a lot of change to this. But short form video content seems to be getting a lot more traction on LinkedIn for a good reason, because it's getting traction on every other platform. So they're trying to hold people on this platform. But long form content, I'm not talking about writing articles, but just, a post where you have, a character limit or whatever, that's usually gotten the best response in terms of reactions and reach, impressions on LinkedIn, in my experience over the years. Video has picked up a little bit, but again, it has to be short form. You have to have subtitles. It's really important to have subtitles, because if you don't, you're missing the majority of the audience who are maybe watching at work and with the sound off. And so you want to make sure you have subtitles. But you can try it out, test it. I always, and again, I'd love to be proven wrong, because things change all the time. And I'm constantly like testing things out on LinkedIn all the time. That didn't used to work, but maybe work now.
Yeah, I mean, my philosophy around the video thing there is that you may not get as much, I guess, engagement as you do, like, let's say, a photo with copy, or just regular copy if it has a hook, right? But I feel that in terms of building that social capital with an audience, in terms of I'm kind of going back to sort of like prehistorical context of people want to be face to face. It builds trust and that sort of thing. I mean, there's a reason why we have so many muscles in our face, right? So I'm like, okay, if I'm not getting as much engagement, but I'm establishing a much deeper connection with those people in my audience, is like, that's the reason why I gravitate towards it. But I've always been like, hey, if I don't do video and I just do the copy, because one of my colleagues I'm connected with is a guy by the name of Josh Ferrari, and he does a lot of just regular copy post and that sort of thing, because people may be looking at it at work, and and whether LinkedIn has anything to do with what they do for a living or not, usually it's like, hey, if you have a video going up on your screen and there's somebody looking behind your over your shoulder, it can maybe be something that people will just basically just scroll by it and not pay any mind.
Right. Yeah, I totally agree with really both sides. And again, you have to really try out and do different things. You can't necessarily be stuck in just doing one type of thing. You got to try out different things. And like this live that you guys do, it gives people an opportunity not only to get to know you and that social capital you're trying to build, but also people in your network, right? Like me, and you're bringing people together. So there is that aspect. When you talk on video, if it's like really edited, it's less so. But when it's something live like this, you get to know someone a little bit more when you hear them speaking. So there is that advantage to it. But again, you have to be consistent and constantly, putting out content so that people can get to know you and understand your brand and connect with your brand, whatever that is.
Yeah. So on the cost segregation side, if you want to talk a little bit about that, I'm finally getting into that space where I would need to enlist your services. I've been just grinding it out on these smaller properties for years and years and years, but I'm entering the commercial world now. So I'm all ears if you want to just kind of give people an overview, and maybe some people that are kind of similar to me where they might not quite need it yet, but what should we be thinking about as we transition into that space, and specifically on like the advantages that we're going to think about as we're doing purchases?
Sure. The basic rundown of a cost segregation, and it's not necessarily only for larger buildings or larger commercial properties. It can be really for any property that's purchased for over like $200,000-$300,000 is really worthwhile looking into cost segregation. And what it is, it's income tax benefit for real estate owners. So excluding, you mentioned this when you brought it up in the introduction, right? Excluding your primary residence, any type of property that is a business or a rental property, you can accelerate the depreciation deductions to a large amount in the earlier years of ownership. So it's essentially a cash flow mechanism that frees up deductions from a pool of potential deductions. So instead of taking a little bit each year of depreciation for 27 and a half years, you can pull forward sometimes 20 or 30% of those potential deductions to the first year or the first few years, which is going to lower your tax liability, allow you to use that money to reinvest. And it's probably the best tool out there for people who are full-time in the real estate business, real estate professionals, because you can use those deductions against your active income. If you're a W-2, you cannot. So there is a distinction there, a really important one that we can kind of dig into the nitty-gritty of that. But there are a lot of rules surrounding it. In a nutshell, it's probably the best tool for people who want to scale their real estate business to basically pay little to no income tax whatsoever in while they're buying properties.
Are there any disadvantages?
There, to everything, there's pros and cons. So not necessarily, I wouldn't say necessarily disadvantage, but one thing that comes up a lot is that anytime you sell a property, you're going to be subject to what's called depreciation recapture tax, which means just like a capital gain, if you sell a property at a profit, you're going to be taxed as a capital gain on that profit. Also, when you sell a property and you've taken these depreciation deductions over the course of ownership, you're going to be taxed on the gain or the unrealized gain of the benefit that you had on those deductions. So you're not paying back the depreciation, but you're going to be taxed on that. So taking more of those deductions up front just means you're going to have a bigger tax bill on the sale. Now, again, it's not necessarily a downside because hopefully, the benefit and the time value of money in using that strategy is usually great in the interim. It's also not necessarily a tax that you have to pay. It's a tax you're subject to, which in real estate is very different than something you have to pay. Being subject to a tax means if you have enough deductions or other types of deferrals or losses, you can actually offset that tax or reduce that tax or further defer that tax and different strategies like that. So there's no really black and white that you have to even pay that. It's just that you're going to be subject to it, and planning accordingly can allow you to reduce that or further defer that tax at the sale.
And isn't the capital gain tax rate less than what you are going to benefit from if you take the advanced depreciation?
Absolutely. And so that's just another thing. It's the arbitrage, the difference of what you are saving by taking those deductions today and paying and not paying tax on your normal income tax rate versus being subject to tax later on a portion of that, which is anyways going to be less and at a lower tax rate. So it's absolutely.
And what about the bonus depreciation I was hearing about? I listened to somebody's podcast and I think the regulations have changed recently. It was like 100% and now it's 80% or something like that, like a lot more.
That's correct. So there's something called 100% bonus depreciation, which means once you've done a cost segregation study and you have allocated, what we do is we break down a property into from 27 and a half year depreciation to faster components like furniture and fixtures and equipment depreciate on a 5-year schedule, and land improvements like landscaping, pavement depreciate on a 15-year schedule. Once you've allocated those costs and segregated those costs to these faster categories, you have the option to take those up front in the first year, called bonus depreciation. So again, it means not only are you getting a bigger tax deduction over a spread of period of time, you actually have the option to take a lump sum. So it used to be 100% of that amount you could take up front. Now it's gone down to 80%, and it's going to continue to phase out as per the tax law right now by 20% each year. So the advantage of this bonus depreciation is going to start phasing out, but it's still a great tool.
And you said that you cannot apply that against W-2 income unless you're a real estate professional?
Well, you can't use the deductions against your active income. So the way depreciation works is that it's considered a passive deduction. And even though we know that real estate is not necessarily passive, but the IRS defines it as passive income, meaning it's going to be treated differently than your W-2 or 1099 or other source of income. That being said, depreciation can only be used to offset your passive income, meaning your rental income. unless you are a real estate professional. If you're a real estate professional, you don't have that limitation, and you're able to then use those deductions not only against your rental income, but then use those against your active income as well. And so that's where the real benefit comes into play.
Can you use it against your wife's active income as well if you're a real estate professional?
You can, and that's probably
There
the
you go.
biggest, yeah, and that's probably the biggest secret in the tax code is this rule about the real estate professional and being a spouse with a high W-2. So I spoke to an accountant this week on Monday, and he mentioned to me that one of the things that he always recommends his high W-2. He's got a lot of clients who are doctors and in the medical profession, and he recommends that they invest in real estate, but also that their spouse, if they're a stay-at-home or whatever, or even if they have another job, go into real estate and become a real estate professional and manage, the properties that you own. Because once you do that, one spouse is a real estate professional, the other is a high W-2. You can use that against the active income, and it's actually end up making more money on an after-tax basis by being the real estate professional oftentimes than having to have both spouses work full-time jobs.
Yeah.
So
That's
hold
incredible.
that thought for a moment. We have a question from LinkedIn from Maria Fignano. She says, I know you're all real estate investors, but you also have businesses. In your opinion, for someone getting into real estate, what percentage of time do you think is appropriate for investing in real estate versus working on your businesses? That's a tough one.
Yeah, I'm probably 50-50.
Yeah, I mean, Maria, I think for me, it's like, I don't know. I think Yonah brought up something like that. When you get to a certain experience level, like you start operating a lot on instinct and the way you feel. I know there's my 20-year-old self couldn't understand this, but like I think that you're never going to be in balance. I think it's going to be a balancing. So you start seeing yourself getting out of balance, whether it's between your active business or your side hustle, if it happens to be real estate, for instance, in your family. And so it's kind of like one of those things. It's like I don't have like an allocation. I don't have an allocation method to it. I kind of operate on on how I feel and where I feel like needs more of my attention. Thankfully, I mean, myself and probably you, Yonah and Mark, like, we have a certain flexibility between both of those worlds to kind of moderate that. But that's kind of my take on it. It definitely changes, but it has to be important. It has to be important enough.
Yeah.
Yeah, I mean, it's a really good question, and like you said, Matt, there's no real right answer. Everyone's going to have a different amount, but I think what's important is spending at least a little time every day educating yourself and seeing where opportunities come up. And I think you'll learn over time. Obviously, if a person is working full time or they're running a business, it's very difficult to do something else full time or do something else to a large extent of the time until you're really passionate about it, until it's really pulling you and driving you. And I think spending more time in something like real estate can, eventually lead to spending more time and more time and more time and more time, realizing, like I've seen many people being able to leave their careers that they may not have been so happy with because real estate is really fulfilling different things in their lives that they really need. So that's been to me fascinating.
Yeah.
So back to cost seg. I don't know, I'm going to give you my scenario because I've always thought about it, right? So I've been a real estate professional for a long time. I have a ton of net loss carry forwards because I do a lot of value add type of deals, and so I don't pay any income tax as it is. So where could cost seg come like be a benefit to me as like in my individual situation?
Just had the phone ringing again over there, so I want to mute that. But the the benefit of cost seg is going to be to help reduce your income tax liability. So someone who already has so many losses that is not going to be able to benefit from it is not going to help you. I mean, the two things that cost seg can help you to do is to reduce your income tax liability or to reduce other passive gains. So if you sell a property and you have a capital gain, the cost segregation deductions, the depreciation deductions, can also offset those passive gains. However, if you don't have any income or you don't have any gains, then there's really no reason to get the cost segregation done.
So let's go on that note in terms of, you mentioned selling a property, for instance, because this is like my worst nightmare is selling a property and then doing a 1031 exchange and feeling like I have a gun against my head in order to kick the can down the road from a capital gains and depreciation recapture standpoint, because that's where I could have foreseeable taxable gains. If I did a cost segregation cost seg on a property that I've owned for quite some time, that would give me like a juicy deduction on it, like could I sell a property in the future and then use those loss carry forwards from that cost seg to essentially, for me to avoid having to do a 1031, because I would only do a 1031 if I absolutely had to, or if I had a property lined up. So might that be a solution for me?
Yeah, that's what we like to call the lazy 1031 exchange, which is using the depreciation deductions in a year where you sell a property and have a capital gain without doing a 1031, and using those deductions to offset those gains. It's not necessarily the best strategy because the deductions from depreciation can be used against the highest tax bracket, like income tax, whereas capital gain is usually a lower tax rate, and therefore you're missing out kind of those deductions. So obviously discuss this with your tax advisor, figure out if it's the best for you, but it's certainly something that I've seen done and can be done.
Very cool. So what do you think, Matt? You got any more questions? I know I was asking a lot at the beginning.
I'm monitoring. I'm just monitoring on LinkedIn because, I saw that one came in from Maria. So I just wanted to make sure that people feel like they're engaged. I run a podcast myself that I have like live Q&A. I kind of equate it to be as like the Oprah show for real estate investors. So we take the first like half an hour, do an interview, and then we'll open up for like live Q&A and that sort of thing. So I was just looking on there to see if we had anything. So I guess going forward, like in your crystal ball, Yonah, what do you kind of see out there in the investing space, the tax space, whatever you're sort of focused on now?
I don't have a crystal ball, and I hate making predictions.
You're always wrong. That's the thing. Everybody's always wrong.
You're always wrong. So it's like, why waste the speech? You can focus on things that you can control. I do, however, follow trends and see what works. And, and I love to listen to people who are much smarter than me and have been doing this much longer than me. This week on my podcast, I interviewed someone who's, been in commercial real estate in New York City for 20 years. And, he's been through different cycles and, told me what it was like in 2008, 2009, and the opportunities that came about at that point. And, and different points throughout the cycle. So again, it's all about not making this prediction necessarily, but just knowing who to listen to. Don't listen to people who are really new. Like someone asked me today, like, is it track record? Like what's considered track record? Like between 2018 and 2020, is that like a great track record for real estate? No, because everyone made money basically in commercial real estate during those years. So you really need someone who has a lot more, track record and, but seeing things and way things are going is a great way in studying the data and just keeping a pulse on it. That's the best way to follow and see what's going to be.
Yeah. So crystal ball question again. All right. Because I think, Mark, I'm going to ask this of every guest on the show. Is the pariah of commercial investment asset classes seems to be office right now. And this mantra of office is dead. I'm challenging that. Because we're definitely contrarian investors. What are what are your thoughts on office?
I think office is a great asset class for people who know how to run it and know what to do. It's it's really a much broader asset class than multifamily, meaning there are so many different niches within the office sector, from tenant base. Yeah, obviously in multifamily, you have different tenant base also. You have an A class property or B class, C class, but in office, you have a much broader, you know, tenant base. I do think there is going to be a lot of opportunity in office for someone who knows what they're doing in the coming next couple of years, because from the data, at least what I've seen, it is the largest asset class that has debt coming due in the next 12 18 months, which means unless rates go down, it's going to be very difficult for people to refinance. In the commercial real estate, refinance is a big part of the game in the strategy, and if you can't do that, you can't do that, meaning and make money and stay afloat, you're going to have a hard time doing it. That combined with the fact that offense has seen vacancy higher than almost ever before. Overall, not saying that there are certain parts they're doing well, or certain asset classes they're doing well. I just spoke to someone yesterday also who was telling me they had an office building leased up to a government tenant, and basically the government is paying the bill for it, and they have an office, not a tenant, sorry, a portfolio of office buildings that are all government tenants, meaning like FBI, you have Homeland Security, you have different things like that are filling these offices. Well, those are not going to default. Those are great tenants to have that have guaranteed leases, and it's being paid by the government. So unless you think that the United States government is going to completely go bankrupt in the next 5-10 years, I think that's a great type of tenant base to have. Different than if you have other types of tenant base. So again, it has a lot to do with that. It's a harder model to be successful with, but if you know what you're doing, you can make a lot of money.
I saw an article that I think a building in Chicago, they're repurposing an office to grow food to be more accessible for the urban population. I thought it was kind of a cool adaptive reuse of an office.
That's great, and that's a great point you're bringing out. Is adaptive reuse is becoming a very hot topic. Kenny Wolf, who's a good friend of mine, just bought his 11th office building conversion to multifamily, and so they're very heavy on that. There are other people who are doing great in that space of finding big office buildings that are vacant and converting them to either multi-use or mixed use or multifamily or other adaptive uses, like you said. There is opportunity there if you can do it. But again, going back to what I said before, you have to really know what you're doing. I wouldn't, if you've never done it before, I wouldn't necessarily start out something like that.
I think in Rochester, they do it a lot, but everybody that develops these buildings, they're getting 40% in credits, 20 state, 20 federal on all hard soft costs. So I think that's driving it here, at least.
Oh, all right. Well, let's wrap up.
Cool. Well, thank you so much for coming on the show. We really appreciate it.
Oh, it's been a pleasure, guys. Thank you guys for having me. Really, I hope we can do it again sometime. And I appreciate you having me on the show.
Yeah.
All right. Take care. Cheers.